Oh, we got a big deck today.
For this? For the flow show?
Yeah.
You're going to give us a whole lot of charts? I like it. Hey, everybody. It's your boys, Chicago Sean, no longer Chicago Sean McLaughlin, and Steve Strazza, our head technical analyst here at All Star Charts. What's happening, Strazza?
Congratulations, Sean, on your new Twitter handle. Should we do like a public service announcement so everybody knows?
Yes. So last night I finally pulled the trigger and changed my Twitter handle from the long-held Chicago Sean. But I changed my name because, look, I haven't lived in Chicago for 11 years. And people like to joke, not only do I not live in Chicago, but I'm neither from Chicago. So it's like, why the hell am I Chicago Sean? So I finally caved, changed the Twitter handle. Anyway, that's not why you're here. You guys are here because this is the Flow Show. This is where Steve and I dig into unusual options activity and see if that could drive us down a rabbit hole into some good ideas, some good trading ideas. We've got some general ideas about how we want to participate in the market right now. I don't know if you want to lead off with that, Strazza, or do you want to lead off with what you see in the latest Follow the Flow report?
So this week's Follow the Flow report is right here. And this week was kind of boring. We didn't have any actionable setups. And for me, I didn't want to even look extra hard for any actionable setups because I'm happy to sit on my hands this week. Then I got to my desk the other day, and you pinged me basically the same thing, right? So I thought it would be a good exercise to talk about, A, the fact that sometimes the right move is to sit on your hands and be patient, right? And B, why we're doing that right now, because maybe you have different reasons than I do.
Sure. I'm happy to go first. I'm happy to show you mine first.
All right, shoot.
Over the last, let's call it 2 weeks, the modus operandi, am I saying that right? The mode of operation over here at my desk has been looking to put on some kind of short premium play because volatility has been elevated across the market for all the reasons that everybody knows. And that provides good opportunities for options traders to put on some delta neutral type trades that are all about collecting premium and letting the fear subside in the market. That's what I've been doing for the past 2 weeks. Now I'm at a point where I've got a bunch of those trades on. We've got the FOMC happening tomorrow where they're going to maybe raise rates, maybe pause, maybe cut. I doubt they'll cut, but either way, there's some uncertainty. There's always uncertainty heading into an FOMC meeting. Not necessarily uncertainty on what they're going to do, but uncertainty on how the market is going to react. But in this case, I feel like there is uncertainty on what the Fed is going to do or what they're going to signal is going to be happening at their next move. And that just sets up a situation where we could possibly have a very volatile day tomorrow in either direction. We could go way up tomorrow. We can go way down tomorrow. It just doesn't feel like the right environment to be putting on new risk trades. I don't want to put on any directional trades now until after the FOMC is out of the way and signals, which way we think the market's going to go. And I don't want to be selling premium here because I just feel like it could be a trap. So I've been sitting on my hands. Those are my reasons, Strazza. Tell me if anything different on your side.
Yeah, I think the market is vulnerable, right, to further downside. We have to be on high alert right now. You pointed out the elephant in the room for why it's a good reason to sit on your hands right now. FOMC meeting. Tomorrow's FOMC, I think, and here's the table. It's the target rate probabilities based on Fed funds futures. Tomorrow's meeting brings a different vibe with it from what we've had the whole past year. Whereas the market's a little bit unsure what the Fed is going to do for the first time in a really long time, I think.
Right.
I think they do 25 to save face. I don't think they want to. And in a perfect world, they probably shouldn't and wouldn't. But I think they freak the market out more if they do 0 here. So I think they do 25 just, to be careful. What more is going to break? The damage has already been done. When we look at the bond market, and we got to watch the bond market close tomorrow after the announcement comes out. When we look at the bond market, this is the MOVE index, which is the VIX, but for the bond market, overlaid with the volatility index, the VIX, right? These charts tend to move, very closely with one another. When we get bond market volatility like we have now, move index at the highest level since 2008, typically the VIX catches up, right? So that would mean more selling pressure, more volatility for stocks. What do you think about this chart?
I think that the risk is that the catch up is going to happen. I mean, if you look back over the past, I mean, you got more than 20 years of data right there, and those two lines more or less have moved in lockstep. So why should this time be any different? I mean, this time could be different, right? But I don't know.
And we're seeing it everywhere. So we did a post last week. Go to the website, check it out. Here's the 2-year yield. On a short-term basis, we haven't seen such a big move to the downside since 1987. So since Black Monday in the US 2-year. High yield versus treasuries. This is basically credit spreads. Pretty big move, making new multi-month lows. Credit spreads are the inverse of this chart. They're at their highest level since like October of last year. This is the break-even inflation rate. So this is inflation expectations. Biggest move since COVID, making new lows in the 5-year break-evens. Spreads, biggest move now to the upside in the 2s10 spread since early 1980s, right? So this is the definition of volatility, all these charts here. And here's the chart porn. This is the spooky one. You know, it's not really when the yield curve is inverted that the market tends to crash. But in fact, the last 3 crashes, the dot-com bubble, great financial crisis, and COVID, they didn't occur until after the 2s10s had bottomed, started moving higher. That's what's going on right now. We can even talk about the volatility in financials. You know, financials having some of their worst weeks since the financial crisis. Got the blow up in Silicon Valley. So for me, easy. This is a great time to sit on your hands. Let's see what the bond market says tomorrow.
You know, this is interesting because this reminds me of the time when the crypto space really started tanking last year, right? I mean, when it was really having the crash that we've all observed. JC would often talk about how, nobody cares about crypto. It's not systemic. Nobody cares. It's the bond market everybody cares about. If the bond market was doing this, we'd be much more on high alert. Well, here we are, and the bond market is very volatile in ways that it hasn't been in a long time. These are the times when we need to be on high alert, right?
Yeah. And I think, I mean, here it is. Watch the 30-year or the 10-year. You have the summer highs from last year, pivot lows, and even in the case of the 30-year, the 2018 highs coming into play. If this level breaks, think look out. We want to see rates stabilize, bonds stabilize, and that would hopefully trickle through. If we continue to see the type of volatility we've had over the past few weeks, over the coming few weeks, I would imagine that it's going to flow through, and you're going to see risk assets and the stock market, not just financials, but the broader stock market come under serious pressure.
All right. So you and I have firmly established that we're sitting on our hands. So if you came here for a trade idea, we don't really have one for you because we're all kind of just sitting on our hands waiting for the FOMC tomorrow afternoon and see what comes of that. And who knows? I mean,
listen,
I think many people are just kind of hoping it'll just be a big nothing burger and then we can move on with our lives. But I don't know. It doesn't feel like it.
It's more about the reaction than what happens, than what the Fed actually does, right?
Right.
It's how prices react to it. Like I said, whether it's 25 or 0, let's see what the bond market does. Let's see how financials react, right? Cyclical assets, you know, here's crude oil. I think the Fed broke inflation. Crude oil, this is some serious structural damage. Commodities are under pressure.
Right.
Not just stocks. So I think like we have levels like this that at least we can look to. So for example, we're talking about volatility for financials. Well, we couldn't be at a better place. If you want to manage risk, you know, if you have some sort of thesis on anything, right? Say you think, oh my God, the damage to financials is so overblown. What a bargain they are here. Okay, fine. But have a level where at least you can prove yourself right or wrong, right? So if you're bullish financials, you think the selling is overdone from the past few weeks, say, okay, I want to step in and buy them here. You have the financial crisis highs right here at 30.50, not even $1 away. So you could use that level to say, okay, well, maybe I'm bullish of financials and I think they're cheap right now. The market doesn't agree with me right now. So maybe I'm too early. right? Or we're back above 30-50. Okay, the market's confirming my bullish thesis, right? So draw a level in the sand, know where you're out, manage your risk responsibly. It's so important in times like these.
Yeah, and going back to the Fed for a second, at the end of the day, at least tomorrow and Thursday, let's say, traders probably don't care whether the Fed raises rates or lowers rates. That's not the immediate concern. I think the immediate concern is they want certainty. They want to have a feeling that the Fed has a handle on what they're doing, whatever it is they're deciding, whether they're hiking rates more or lowering rates. They want to know that the Fed has a handle on what they're doing and has good reasons that they could communicate to the market of why they're doing it. If the Fed gives off any kind of signal that they don't have any friggin' clue what they're doing, that's what scares the market. That's where we could see some real big volatility come in. And I feel like that's what the risk is tomorrow.
And that's exactly what I'm saying, Sean. The decision that gets that reaction is doing zero at this point, right? Because think about it. They've been out here, even when Silicon Valley Bank thing started, Powell was out here sounding like, we still have to fight inflation. We're going to stay the course, yada, yada, yada. We haven't heard much dovishness, right? So if they come out now and do nothing, I think that's going to spook people into thinking, well, what have they heard? What do they know that we don't know? Because understand, the Fed has been at all these meetings with these regional banks for the past 2 weeks, right? They're behind closed doors hearing things that the rest of us don't know. So if they come out and do nothing, I think that can really have a opposite effect of what they intend.
So let's leave our viewers with this, Strazza. Let's hope tomorrow that the Fed steps forward confidently in either raising rates or lowering rates, whatever whatever. Just do something and make the signal that they know what they're doing and this is why. And if they do that, I think things are going to work out okay over the long run. But if they do nothing, that's where we get worried, and that's where whoa boy, time to start managing risk.
We could point to a lot of positives over the past few weeks too. I don't want to sound too bearish, right? We've had the outperformance from tech. Growth looks good. Bitcoin's at 9-month highs, right? There's plenty of other things we could point to. It's just we're at a fragile place right now, right? And I don't like the way the bond market has acted. Whenever the bond market perks up and starts, showing volatility like we saw last week and the week before, you really want to pay attention. So I think we should just be on, raised alert right now, especially heading into a very important FOMC meeting. So.
All right, you heard it here, folks. Me and Strazza, we are flowing to the sidelines and just waiting to see what happens tomorrow afternoon. All right, everybody. Next week, hopefully, we'll have some ideas for you. We'll have some clarity on what the next move in the market is. So until then, thanks for tuning in. Strazza, thanks as always. We'll talk to you guys all next week. Bye-bye.
Later.